The official unemployment rate in the United States is holding near a historic low. Today's report from the U.S. Department of Labor shows that in September, the unemployment rate fell 0.2 of a point to 3.7%. That's the lowest rate in 49 years. Since 1969, the economy added 134,000 jobs last month, which is less than experts estimated, although the Labor Department says some of that could have been a result of the impact of Hurricane Florence and the Leisure and Hospitality Index. And here to help us dig into the numbers is John Grace, the founder and president of Investors Advantage Corporation, who joins us from our LA studio, and Peter Schiff, the CEO and chief global strategist at Euro Pacific Capital. Welcome, guys. Great to have both of you, and good to have you together. John, first of all, what do you make of these numbers? And I also want your take on wage growth.
Both good questions, Bart. Good to be back with you. So it's really kind of a whiffle. I mean, you know, if we're off 50,000, that's really not remarkable. Had the numbers been off 3, 4, 500,000, that would be remarkable. But let's consider where most people enter and exit the workforce. That's part of the equation. And then let's look at job growth in terms of inflation relative to wages. So we enter the job market typically about 19 or 20 on average. That's when people take their first job in America. But we exit about age 63, and it doesn't matter how strong the economy might be. If you're going to exit at 63, that's the average retirement age. It's just something that Father Nature and Father Time and Mother Nature, they hold the true trump card. So whatever it is we're trying to do to make it an environment where people are working, that's good, but let's look at the quality of those jobs. Let's look at the income, and let's look at inflation. So we can see, for example, in 2008, the numbers were the same. We'll start at an annual income, household income, where there's 1 or 2 people in that household, making about $57,000. But just to keep up with inflation, that was averaged about 1.6%. My firm has looked at over the last 10 years, that would mean that we need to have an income of about $67,000 today. And as of 2017, we were at around 61.4 in round numbers. So clearly, inflation for jobs has been running at about 0.66. As you know, that's slightly more than 0.5% per year versus inflation of 1.6% per year. So even those with jobs, to the extent that we have a job, it may not be the same income. And even if it is the same income, and if it's not at close to $70,000, our ability to spend is declining as house prices have been rising for the same time period of a cumulative about 35% or 3.5% per year. So the numbers are interesting when we dig in the details.
And Peter, I really, I noticed you shaking your head in agreement on some of that. I want your reaction, but I'm really interested in this debate, Peter, that's been going on. It was a couple of weeks ago where Larry Kudlow, the economic advisor to the president, said, right, wage growth is really a lot higher than the figures say. I mean, the figures from their own Department of Labor said. And so there is this question about whether or not it's calculated right. So what do you make, Peter, of wage growth? And do we need to somehow consider whether or not a recalculation is in order?
Well, first of all, a lot of things need to be recalculated. I think the way the government measures inflation, I think it does a bad job of capturing the true increase in the cost of living. So I think real wages have actually fallen a lot further than the official statistics would reveal. And of course, you mentioned at the top of the show about this lowest unemployment rate since 1969. Well, as Donald Trump used to correctly point out when he was a candidate for president, that the numbers are not real because we no longer measure the unemployment rate the way we measured it back then. If we did, and we counted all the people that are working part-time who want to work full-time, and all the people who are discouraged, not just the people who are discouraged for 1 year like we get in the U6, but all the long-term discouraged unemployed, the real unemployment rate is well above 10% right now. So we're not even close to where we were in 1969. But also you have to remember, by 1970, the unemployment rate had soared back above 6%. So things can change very quickly. And, you want to talk about what's happening to wages. Look what's happening to interest rates. Interest rates are rising sharply. They have a long way to go. A lot of Americans who have jobs also have debt. They have mortgages. They have car loans, student loans, credit card debt. All that is going to be eating a bigger chunk of their income. Gas prices are rising. Oil prices have almost doubled this year. They're going to keep rising, especially when the dollar starts to fall. And these Trump tariffs are just going to add more to the rising cost of living. So I think real wages are falling. And pretty soon, employment is going to be falling too, because look at the housing market, look at the auto market. We are headed to recession, and we're in a recession. A lot of jobs are going to be lost, but the cost of living is going to keep rising. This is going to be stagflation, so it's going to be much worse than what we had in 2008 and 2009.
Real quick, we've just got a little bit of time. John, can you give me the sectors just real briefly that did well in this job report? And then, Peter, I'm going to ask you for the ones that didn't do so well. John?
Well, certainly it's technology. By the way, I mean, just look at it this way. When we look at the average household income, 2018, it's about $62,000. Now, to Peter's point, let's just go backwards. And what we've seen, literally for the first time, is we started at $57,000 in 2008. For 4 years, we went negative. For 4 years in a row, we went below $57,000. So this downturn the last time affected, on average, as more dramatically than we saw. It wasn't until 2013 that we got above $57,000 again. Now, if we look a little more closer under the hood, we can look at the household average. When we go by ethnicity, it becomes a lot more interesting, certainly to me. And that's first to see, again, whether there's one or two people working, about $61,000, $62,000 on average. If we, on the other hand, we're African American, it's a little north of $40,000 household income. Hispanics only about $47,000. Asian Americans, by contrast, are around $80,000 household income. So it would seem to me that maybe we can't change our background in terms of genealogy, but it might make sense to get some new skills, and certainly math and science are two of the ones that where the future is going. It's not about working in a coal mine anymore.
And just real quick, Peter, we're out of time, but tell me about the sectors that were the not-so-great ones this last month.
Yeah, you know, we can't find those kind of people because too many kids are in school drinking, as we've been talking about a lot lately with respect to Kavanaugh. That's what goes on in U.S. colleges now. It's a lot of drinking and not a lot of math and science. But the big problem here is that we are continuing the disturbing trends we had under Obama of creating low-paying service sector jobs, a lot of part-time jobs, and all these jobs are a function of the bubble. And when the bubble pops, the jobs go away. It's all been a function of artificially low interest rates. We built an economy on a foundation of cheap money. That cheap money is getting a lot less cheap. Soon it's going to be expensive, and that whole house of cards is going to come tumbling down.
Thank you so much, guys. Really appreciate it. Super interesting, as always. Peter Schiff, the CEO and Chief Global Strategist for Euro-Pacific Capital, and John Grace, the founder and president. We sure appreciate you being with us. Thanks, guys.
Sure thing.